You think you're invested in the US economy if you buy the S&P 500, but what you're really invested in is big tech. Most investors believe that by putting their money in the S&P 500, they are spreading risk across 500 different companies. But what if I told you that so-called diversification is an illusion? In reality, a handful of massive corporations dominate the index, dictating its movement and exposing investors to concentrated risk. Alright, let's start with some transparency. VOO, the ETF that tracks the S&P 500, makes up 50% of my investing portfolio. So let me be very clear. I'm a very strong believer in index investing and the S&P 500. In fact, the index covers roughly 80% of the US stock market's total value, spanning all major sectors of the economy. No single stock can possibly dominate an index that large. Many investors buy the S&P 500 and feel confident that they've got a finger in every pie. Tech, healthcare, finance, retail, you name it. But here's the plot twist. Owning 500 companies is not the same as being equally invested in 500 different companies. The S&P 500 is market cap weighted, meaning the bigger the company's valuation, the larger it's a slice of the index. So while you do own a tiny piece of hundreds of businesses, the bulk of your investment dollar is concentrated in the top holdings. To uncover those names, let's peel back the curtain on the S&P 500's most dominant players. Take a wild guess. Which sector rules the S&P 500 today? If you answer technology, bingo. The information technology sector alone makes up about 1/3 of the S&P 500's total weight. But it doesn't stop there. Many of the companies classified under other sectors, say Amazon or Tesla, which are officially consumer discretionary, or Google and Meta in communication services, are tech-driven at their core. Add those in, and the index starts to look like a who's who of modern tech giants. Let's name names. As of early 2025, the list of the top S&P 500 holding reads like a big tech hall of fame. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, and Broadcom are all in the top 10. These titans have grown so large that their combined weight dominates the index. For instance, Apple alone accounted for about 7% of the S&P 500, with Microsoft not that far behind at around 6%. Nvidia, a single chip maker, weighs in at around 6% as well. Add Amazon, Alphabet, Meta to the mix, and just 6 companies collectively represent approximately 30% of the entire index. Think about that. 6 out of 500 companies taking up nearly 30% of the S&P 500's market cap. That's concentration on a massive scale. In fact, this is the highest level of top 5 concentration we have seen in decades. This domination means that when you buy the S&P 500, you're implicitly making a big bet on big tech. Whether you realize it or not, your fortunes are tied to Silicon Valley and friends. That's great when tech is soaring, as it has for the past decade, but it can be a double-edged sword when the tide turns. Concentration in the S&P 500, by the way, isn't entirely new. There have been episodes in the past where a group of superstar companies grew to dominate the index, but today's situation is extreme by historical standards. Between 2010 and 2024, the share of the index held by the top 10 stocks doubled from 19% to 38%. So, why does it matter? Think of it like a table with 10 legs versus a table with 500 legs. If you knock out one leg on a 500 leg table, no biggie, right? But if those 500 legs really boil down to 10 big ones, knocking out just one or two can make the whole table wobble. Secondly, over concentration means diminished diversification benefits. The whole point of diversification is that when one investments zig, others zag. You want your portfolio to have varied drivers, different sectors, different sizes, different geographies, so that no single slump devastates your overall wealth. But if 30 to 40% of the index is in similar mega cap tech names, well, you've lost a lot of that buffer. So what are the alternatives to real diversification? Here are a few approaches to consider. The bucket strategy. I've talked about this multiple times in previous videos as well. This is where you divide your investments into different buckets, each with a very specific role, which inherently diversifies your risk. So for example, one bucket could be your safe assets like your cash or very short-term bonds for stability and near-term needs. Then your next bucket could hold moderate to medium-term growth assets like dividend stocks or longer-term bonds. And then a final bucket can be growth-oriented like stocks and riskier assets for long-term growth. The idea is that if one part of your portfolio is struggling, say the long-term growth bucket during a market crash, you have other buckets like your safe bucket to lean on. This strategy not only mixes asset types like stocks, bonds, and cash, but also time horizon. Second, go international. Don't put all your eggs in the US basket. The US stock market has been the powerhouse, but it's not the only game in the town. Investing in international markets can provide a crucial hedge against US-centric risk. Remember, the S&P 500 and the US stocks in general dominate the global stock market. As of the end of 2023, US listed companies made up about 59% of the world's stock market value, with the S&P 500 alone constituting to roughly 51% of the global market cap. That's huge, but it also means that approximately 40% of global equities lie outside the US. If you ignore international stocks, you're missing exposure to many of the economies and industries that might grow outside the US. I have international exposure through Vanguard's Total International Fund, or VXUS. And if you would rather only invest in US stocks but would like to broaden your reach beyond the S&P 500, consider the total market fund like Vanguard's Total Market ETF, or VTI. VTI gives you exposure to the entire US equity market, including mid-cap and small-cap companies that the S&P 500 totally leaves out. Instead of 500 stocks, you will own 3,600 stocks in one fund. That means companies in all shapes and sizes, from tech giants like Apple to smaller regional banks or up-and-coming tech firms, are all in the mix. This can dilute the concentration a bit. It's still market cap weight, so big companies are still going to dominate the fund, but at least you have exposure to small cap and mid cap companies as well. Fourth, real estate. Stocks and index funds are great, but they don't offer everything. When the market drops, there's no rent check coming in to soften the blow. Even in economic downturns, people still need a place to live, and well-located rental properties can provide consistent income regardless of what the S&P 500 is doing. That's why I absolutely love real estate as well. It's a big part of my overall strategy. With real estate, just make sure that your finances are a bit more stable before you take the leap. And remember, it's a lot more hands-on than index funds. Lastly, diversification also means including other asset classes. Consider bonds, REITs, or even commodities in your portfolio. They don't move in lockstep with stocks, which gives you a buffer in tough times. The overarching idea is that to expand your portfolio beyond just the standard S&P 500. And I want to make one thing very clear. I am a big fan of index investing and the S&P 500. In fact, once again, it makes up 50% of my portfolio. So this isn't me saying that there's something wrong with the S&P 500. But here's the thing. You might be putting your entire retirement on just a few companies without realizing it. If you're in your 20s, 30s, or even in your 40s, that might not be a big deal. But as you get closer to retirement, having some diversification becomes so much more important. Personally, I invest heavily in the S&P 500, and I also have some exposure to international markets, a little bit of bonds, some growth stocks, a tiny bit of Bitcoin, some physical metal, and a significant chunk in real estate through rental properties. I feel like I'm diversified. Are you?